Hi, this is Sean Johnston from Centric Wealth Advisory. This is another video to go through a template which I think will add a lot of value for those that are just wanting to understand the differences between voluntary and compulsory funds at retirement. Voluntary is also known as discretionary, and compulsory is also known as non-discretionary. The non-discretionary is generally all your retirement funds, well, you need to convert that into a living annuity at retirement, or you can go into a guaranteed annuity. A guaranteed annuity works differently in the sense that you would have to get actuarial rates from the various companies. You'd have to see what those rates are. You can decide to have escalations on that guaranteed income, but the main reason why you'd want to get that income guaranteed is because it is independent of market performance. There is no funds invested. There are no asset classes involved. It is a set guaranteed income that will pay out for the life of the first dine. You can also nominate a second dine, which is generally the spouse, and you can have guarantees on your income for a period of time. Normally it's 10 years. And then basically long term, what happens is that the life company will keep the lump sum that's been invested. That's the only downside of guaranteed annuities. Whereas a living annuity is an investment where you invest the money into funds. It is not Regulation 28 compliant. You can go into any fund asset mix as you wish. And you're restricted between a 2.5 and 17.5 drawdown per year on your income. And you're allowed to change your income once a year at anniversary. With discretionary money, that can be money from a unit trust, money from endowment, whatever the case is, you're drawing the money. There's no restrictions on the annual drawdown. And the objective here, of course, is to show you the differences between the two so that you understand when you are drawing income at retirement, the depletion of the two different types of funds. So what I'm going to do is I'm going to do an example to show you on a comparison tab how the two funds work when you limit the drawdowns. And then I'm going to play around because what you can do with this template is you can also use different ages. You don't have to use 65 because you can access your retirement funds at 55. Obviously, the longer you leave your money in general, you can have more compound interest and you can have a higher fund value, which makes a lot more sense. But just for illustration purposes, I'm going to use the same scenario where the client 65 is investing 1.2 million, drawing 8,000 Rand in year one. That's escalating at 6%, and we're anticipating a 10% return annually on the capital invested. 1.5% ongoing fees, and that can be for advisory fees, platform fees, asset management, ongoing administration, whatever the case is. You would just take the total expenses and you'll put the amount in there. And we are working on an average of, it can actually really just make it 18% in this case. I'll do the same over here. In reality, obviously, your income's dependent on what your your tax table is. So in this case, 8,000 Rand would fall into the 18% tax table. But as your income starts getting higher due to the escalations, it could go into a higher tax bracket. But I'm just going to work on an average of 18% for this example. So what we want to see here is the 1.2 million Rand is invested. We're drawing 96,000 from that. This is the tax. This is the amount before, after tax. This is the annual income after taxation. This is the ongoing fee, which is the 1.5%. The remaining amount, there's the growth on the remaining amount, and that's the balance, and that then carries over. The drawdown starts off at 8%, and then it then increases to 8.5. Now, you just wait to see what happens is that if you do not escalate, then your drawdown will increase at a slower rate compared to that amount where it does. So what's important to note is that when you're drawing income from retirement funds, you need to look at the longevity of the capital. So we see here that if this investor is drawing 8,000 Rand and escalates it at 6%, their money is going to run out in 14 years, which means that obviously in 14 years, the client will be about 79 years of age, the investor, when that happens, which means this fund balance goes to zero. I'll take in the same scenario with compulsory money or non-discretionary funds. You can see here that it's 8%, 9.5, 9.1, 8.5, 9.1, 9.8. And what happens is you get to a point where in this case, it goes above 17.5. So on voluntary money, there is no cap. So you actually run out of money a lot quicker in voluntary funds. In compulsory funds, because it caps at 17.5%, as you can see, the income over here will still be available to the investor, but it will deplete at a slower rate. And you can see here the income, even though you're escalating at 6%, is reducing. Why? Because it is capped at 17.5%. Now, the best way to illustrate that is to put it onto graphs next to one another. So what I'm going to do is just zoom in. This is the voluntary funds from the age of 65. And as we can see, by the time the client gets to around 79 years of age, their voluntary money of 1.2 million is completely depleted. However, with compulsory money, which is why this was introduced for retirement funds, 65 is the retirement age, exactly the same income as you can see. But because it is capping at 17.5%, the money will last even beyond 100. And to show you what I mean, I've got a full table option here, and we can actually see that even when the client is 135 years of age, they're getting 10 Rand. Okay, obviously in reality, the client most likely would have passed away. But the point I'm getting at is that the reason why there's a 17.5% is so that the money prolongs, even though the income itself is reducing. And the only risk there is that what is the buying power of this money if inflation is 6% and it's reducing? So that's where one could potentially play around and say, well, why don't I make this 70 and we'll make this and see what happens. So now we're taking age 70, 65, and we can try and plot it onto a table here. And we can see from 70, 8,000 Rand has been generated. Now, just obviously bearing in mind here, let's see if I change this around to do, because what we want to see here is the impact. Let's just swap it around, because I have designed this so that you can see if it'll work. Yes, okay, so I've had to design this so that you access voluntary money first, and then you access your compulsory money later. So you can see over here, from age of 60, we are drawing from the voluntary money. And then from age 65, you start drawing from your compulsory money. So you can see that the voluntary money started to escalate. And as a result, you can start to see how the two incomes are combining. So it starts off with 8,000 Rand, 8,4, 8,9, 9,5, 10,000. Then it goes to 18. And then we can actually plot it, just see what's going on over here. You can see, look, obviously just bear in mind, it's a 5-year gap, but we can see more or less when the money will run out. So now what we could potentially do is we say, well, maybe we escalate this at a smaller amount per month, and we start the 65, maybe make that 10,000, and we start it off at, and we have it escalating at 4%. Then you can see the comparison again. And the point I'm getting at is when you get to retirement, this is what you're going to have to be deciding upon when you've got your retirement funds. Now, obviously, this is not an ideal situation if a person is drawing such a high percentage. In reality, the person should only really be drawing, let's say, 5,500 Rand from 1.2 million. But I just wanted to show you for illustration purposes what happens when you are starting to compare the two. And of course, when you compare it here, you can see the different ages. And you can see now, this is a bit of a better scenario, of course, because on your voluntary fund, starting at 60, your money's going to last a lot longer because we're drawing a lesser amount. And maybe with the compulsory money, we then boost that up to, let's say, 8.5. Because even though the money is capping, it's still going to be available. And then we can actually plot it. So now you can see this is going to run till 89 on voluntary money. And your compulsory is going to reach the 17.5%. But if you actually plot the two together, the client will start off with 5.5 at age 60. Let's say they retire at 65, but they just need some money over and above whatever income they have leading up to retirement. They retire at 65, they get the 15, and this starts to escalate at the various rates. So we're saying this escalates at 4%, this escalates at 4%, maybe we escalate this at 6%, and we can then plot it and see how it looks, because then we can see here individually the money will still last, and this will run out with the time client gets to 89. So we can see here now that at retirement it's 15,000 Rand, and that's escalating with inflation, or one's escalating with inflation, sorry. And then you can start to plot it out until the point where your voluntary money is left when the client is in their 90s. Obviously, it's not ideal. As you can see here, the income is still growing with inflation. And then it gets to the point where the client is 76, where it starts to reduce in real terms. And the reason for that, of course, is that your compulsory money is starting to reduce the 17.5%. And your compulsory money is also starting to deplete. As you can see, the rate is starting to go down. If we go into the graph over here, we can start to see what I mean by that. The drawdown rate's going up at a faster rate, and therefore it starts to deplete to the point of complete of zero. And I created this for myself really because I wanted to understand the differences between the two when you model it. And this is a calculation you can't really do on a calculator because you don't know exactly when it's going to reach 17.5, and your time value of money calculator is not going to know either. And secondly, you're not going to know exactly when the money is going to run out, because you can actually do a time value of money calculation. And I've done that already. There's actually a time value of money calculation here that works independently from this. This here performs exactly the same thing that a time value money calculation would do if you were to put it into your HB 10B2. It work exactly the same way. Only difference, of course, obviously, you need to minus the fees off when you do your growth. So in other words, you take 10 minus 1.5, and then you work out the resultant rate that way. But the point is, you can use this now just for education purposes to just better understand the difference between the different fund types and how you would navigate choosing which. Now, we are going to go into a retirement planning template, which I've created, which also has the different funds in there, but it's a bit more comprehensive. This is really just showing you from a illustration point. You're going to do a lot more practical calculations with an actual client that has retirement goals, and we can start pulling money through, and then we can decide how to allocate those funds accordingly. So this is just a sort of a entry into the different allocation of funds, how to learn more about that. You can expand the table if you want to. You can put whatever scenarios in, but just note, I've created it so that you have to have the voluntary money accessed first at an earlier age, and then the compulsory money at a later age. And it's just purely because voluntary money, in most cases, people would access first because they necessarily don't have to take an income right away. They might take a lump sum to settle debt and things like that. As I said, there's no restriction with regards to annual drawdowns. Also, there's no restriction to what capital you can unlock. Obviously, understanding the tax implications, etc. But the point I'm making is that this is how you would just better understand the different types of funds at retirement. And of course, as I mentioned earlier, instead of living annuity, you could go into a guaranteed annuity. And to be honest with you, in a scenario like this, I think a guaranteed annuity might be a better option, because let's say the annuity rates was 7,500 Rand. That 7,500 Rand is guaranteed to increase if you go and add in a it's actually probably higher than 7,500 Rand. We've actually done a 1.2 million recently, and the quotation was about 993, and that had an escalation in line with inflation guaranteed. So in this scenario, the guaranteed annuity makes a lot more sense. Obviously, if it's a larger capital amount, let's say it was 5 million Rand, and the client was drawing down 12,000, it's quite low. Just bearing in mind it is between 2.5. So if you were to go and put in 10,000 over here, there'd be a warning saying that you actually can't. You have to increase it to the minimum. So let's work on 15. And this is how, of course, if the client's got a larger compulsory, then they might use their voluntary and then kick in the compulsory later down the line. So if you were to go and put this scenario in now, you see what I mean. As the client is getting closer towards depletion of their voluntary funds, their compulsory is growing quite nicely. So the person could draw down less now and maybe increase it later as they get older. So they say this is how you can model it. It's just purely for education purposes, but in reality, when you're doing retirement planning for clients and you do the reviews, this is what you're going to be looking at. You're going to be looking at the depletion of all their funds, how's their funds depleting, do the calculations. But this just gives you an idea leading up to retirement, where to focus your attention. I really strongly believe compulsory funds definitely are recommended, because not only are you prolonging your retirement, but you're also getting tax-free interest in the funds leading up to retirement. So the fund balance that you have at retirement has accrued with all the interest that has not been taxed, and also there's no capital gains tax in the fund, so that you're getting the best possible returns in your funds without paying tax. And with your voluntary money growing towards retirement, if you earn interest that's above the exemptions, you're going to have to add that to your gross income and pay potentially tax on that. And with your retirement funds, of course, you get to rebates. We have a separate template, which you're going to get to as well, which is quite complex. We're going to look at what happens when you reinvest your rebates back into your retirement annuity. And we're also going to look at all the funds that are not tax deductible, and what happens when you use those funds that are not tax deductible, the contributions, and we're going to apply them towards the 1/3 lump sum, or we're going to comply to the living annuity. Similar template to this, but we can see on a separate calculation how much can we recoup in terms of the funds that were, or contributions that were not deductible. We offset that against tax, and we can see how many years it will take to actually recoup the full amount. That's going to be in a future video, but for now, just play around with this template, and hopefully this makes sense. Welcome to put any scenario in, but just as I've mentioned before, if you want to do a comparison, rather please access the voluntary funds at an earlier age, because it's going to show you the cash flow like this. It's going to show you the voluntary funds. I've tried to switch it around. It's very difficult to do that in Excel, especially when you're working with two different cash flows. There's actually a lot of calculations behind this graph, which you don't see. But the point is that just use the example, you access voluntary money first, or at the same time as compulsory, and then it'll look like this. I'll actually will make a note at the bottom of this template by the time you get to download it, just so that you are aware to always make voluntary money accessible first, and then when you get to the compulsory, you can make that later age if you want. It's just because once voluntary money hits the 17.5, it reduces, and it's not ideal, versus voluntary money, which doesn't have that problem, but you run the risk of depleting your funds to zero a lot faster than compulsory funds. Hope that makes sense. Thank you so much for taking time to watch this video. And if you have any questions, you're welcome to make comments in the video, but look forward to making another video for you and sharing the template I've just discussed. And also we'll get to the point of doing the retirement planning template, which is a very large document. We'll break it down into a few videos so I can explain it in detail. and it'll encompass everything we've gone through thus far with regards to all the graphs and tables and things like that. And then it'll hopefully make a lot more sense because we actually go through a client and put in all the provisions, work out the shortfalls, and then we'll also do recommendations for that client. But we'll get there. Just go to the videos week by week, and hopefully this is adding value to your learning experience. And if there's any suggestions, please feel free to reach out to me. Thanks very much. Ciao.